Global stock market traded with a mixed tone on the Wednesday as the investors weighed interest rate expectations, upcoming economic data, and the corporate earnings. Also, the United States equities slipped across the major benchmarks while the Canada posted modest losses and the Latin America markets diverged, with Brazil also showing resilience even as the Mexico and the Chile retreated. On the Wall Street front, the downturn was the broad-based sell-off, also the relatively mild outlook, also the Dow Jones Industrial Average that fell 171.5 points or zero point 0.3 points to the closing of 46,121. Also, the S&P 500, widely regarded as the best barometer of the United States market, lost 18.9 points or 0.28%, finishing at 6,600. The tech-heavy names also saw selling pressures at the Nasdaq Composite declined 75 points or 0.3% to 22,000. Also, the small cap stocks were hit harder, with the Russell 2000 sliding 0.92% to 2,400. Also, interestingly, despite the declines, the investor remains never and also appeared the steady in the CBOE volatility index that slipped 2.7%, suggesting that traders view the pullback as profit-taking rather than a deeper sell-off. Also in the Canada, the equities mirrored the US trend, but with the softer losses. The S&P/TSX Composite Index dropped 58.68 points or 0.20% to also the settling at 29,700. Also, while the S&P/TSX 60 edged down to 1758, the energy and the financial stock dragged on the performances as the investors tracked the oil prices movements and the global demand outlooks. Elsewhere in the Americas, the markets presented a mixed picture. The Brazil's Bovespa index managed to buck the trend, inching higher by 66.81 points or 0.05% to 146. Also, the gains in the commodity-linked sector helped offset the global risk of sentiments. In contrast, the Chile's S&P IPSA also fell 32 points or 0.3% to 9,100, while the Mexico's S&P BMV IPC suffered one of the sharper declines in the region, sinking 462 points or 0.7% to 61,905. The divergence underscored how country-specific factors from the industrial performance to the consumer demand continue to shape the market direction. Overall, the trading across the regions was marked by caution. The industrial and the investors are also awaiting the key U.S. economic reports on inflation and jobs, which could have heavily influenced the Federal Reserve monetary policy path. With the indices still near the record highs, even slight surprises in the economy data could swing the market sentiment quickly. The analyst noted that the recent pullbacks are likely to be part of a natural pause following a strong gain in the recent weeks rather than a shift towards the prolonged weakness. Also looking ahead, the global markets will continue to react to the central bank signals, the corporate earnings, and the macroeconomic data. For now, the volatility remains muted, suggesting the investors are not rushing to unwind the positions but are instead adjusting the portfolios carefully in anticipation of the next market-moving catalyst. The commodity markets traded mixed on the Wednesday, with the energy prices mostly lower, the metal showing slight weakness, and the agriculture products edging higher. The traders also balanced shifting the supply-demand dynamics, also geopolitical considerations and currency movements were seen while keeping an eye on the broader economic outlook data that also continues to influence the raw material demand. Also, the markets are a little bit edgy. In the energy market, the crude oil prices slipped as the investors reassessed the global demand prospect. The WTI crude oil future fell $0.29 or 0.4% to settle at $65 per barrel, trading within its 52-week range of $55 to $79. The Brent crude oil, also the international benchmark, eased, declining 0.24% and also to nearly $68 per barrel compared to its yearly range of $58. Also, the analyst attributed the mild pullback to concerns about slowing demand growth, particularly in the major consuming economies, although the supply discipline from the OPEC Plus members provided some support. The natural gas also bucked the trend, rising $0.2 or that is the $3 per million BTUs, with the prices moving between $2 to $4 over the past year. Stronger seasonal demand and the tightening inventories gave the contract a modest boost. Also, the precious metal traded with little conviction as investors awaited further signal from the central banks. The gold futures were virtually flat, dipping just 0.02 to $2,000 an ounce of the holding upper end of the 52-week range between $2,500 and $3,800. Silver slipped slightly, that is to $44 per ounce, after recently testing highs near the $44. The market participants are saying that the metal is complex and consolidating after the sharp gains, with the safe haven demand steady but tempered by the strength in the US dollar. Agriculture commodities were mixed but generally firmer. The soybeans rose by 0.2% to lead to $10 per bushel, supported by the steady export demand and concern about weather patterns affecting the crop yield. Also, prices remain within a relatively tight 52-week band of $9 to $10.